This is the information, the contact information for presenters, Francisco, Luis, and Omar Muez. And also, if you want to interact directly with us, here's the information to do so, and we'll be happy to do so after the web. This is the agenda that we have for our discussion today. First, we recognize that we have participants that are not from Puerto Rico and may want to have a brief update or a brief summary of what's Puerto Rico as a tax jurisdiction. So we'll be discussing the general framework of the taxation in Puerto Rico in order to put in perspective the incentives. We have several laws in Puerto Rico that provide incentives, but we are going to concentrate in just 4 acts today. And after the discussion of the incentives, we will be addressing the new rules that we have at the federal tax side, considering what was the scenario before these new rules and how the rules now affect the international tax environment. In addition, we will provide some planning considerations that we may consider on light of these new rules. So let's go to Puerto Rico first. As you know, Puerto Rico is a U.S. territory. We are located in the Caribbean. We use the U.S. dollar as our currency, and Puerto Rico-born individuals are U.S. citizens. Generally, and this is a general statement, Puerto Rico residents and businesses that are created here in Puerto Rico are not subject to federal taxation, and that's basically how the incentives has been elaborated throughout the Puerto Rico recent history. Puerto Rico have a privileged geographic location. We have easy access to the U.S., to Latin America, and to Europe. We have direct flights to major cities in the East Coast of the U.S. For example, it takes 2.5 hours to get to Miami, 3.5 hours to get to New York. And through most part of the year, we have even direct flights to Spain, which takes about 8 hours. Our population, and this is based on last year's census, even after the hurricanes, we have approximately 3.2 million inhabitants in Puerto Rico. We have lost probably like 10% of our population in the last decade. And Puerto Rico residents and businesses are not only protected by the Puerto Rico Constitution, but also by the U.S. Constitution. So that provides the framework for Puerto Rico legal relation with the U.S. We in Puerto Rico have all U.S. legal protections. We do have access to federal funds and government contracts. The intellectual property that is generated here in Puerto Rico is also protected by the U.S. laws. And one of the main attractive tools that we have for our manufacturing industry in Puerto Rico is that since we are a U.S. territory, we are able to use the Made in USA label and brand. This has proved to be a valuable resource for Puerto Rico. Our banking system in Puerto Rico is regulated. It's the same banking system as in the U.S. The FDIC secures the banks here in Puerto Rico. And the cornerstone of the Puerto Rico incentives is actually based on the U.S. tax law. As we know, Puerto Rico-born individuals are U.S. citizens, and we have a particular section in the U.S. code, and we don't want to get technical in the webcast because we want it to be informative. But this is like the main tool for the Puerto Rico tax relation with the U.S. And it's that this particular section in the U.S. code provides that the Puerto Rico bona fide resident excludes from federal taxation the income that is Puerto Rico source, that is generated here in Puerto Rico. And that is why most of the Puerto Rico residents, that all of their income is generated here in Puerto Rico, even though they are U.S. citizens and the U.S. tax law have a worldwide tax regime for U.S. citizens, the bona fide residents of Puerto Rico are not subject to taxation in whatever they earn here in Puerto Rico. On the other side, we have that the entities created in Puerto Rico, even though it's a U.S. territory, they are considered foreign entities for purposes of the U.S. tax law. So if we have an entity that is created in Puerto Rico and that entity does not have it is not engaged in a trade or business in the U.S., it will not be subject to U.S. taxation. That is what's called like a fiscal autonomy that we have here in Puerto Rico. This slide provides some bullets about the main areas that we have of incentives here in Puerto Rico. Those that are highlighted in blue are the ones that we are going to be discussing today. We're going to be discussing about manufacturing, tourism, export services, and the new investor residence that we have in the island. So let's go to the incentives. This is the slide that these are the particular laws that we are going to be discussing: Act 20, Act 22, Act 73, and Act 74. We will be making reference to these particular acts throughout the discussion. So at this point, I'm going to leave Omar to commence the discussion, the particular discussion about the incentives. We will be providing a summary of the incentives, some of the new recent changes, and then after that, we will be addressing the federal tax rules.
Good afternoon, everybody. This is Omar Muez. I'm going to be discussing Act 20 specifically. Act 20 was enacted on January 17, 2012, and it provides tax exemption benefits to export services specifically. For income tax purposes, the Act provides a flat income tax percentage of 4% on the net income of certain eligible services provided from Puerto Rico to outside markets specifically. The benefits of Act 20 are secure with a tax exemption grant, which is a contract between the government of Puerto Rico and the entity negotiating the exemption. Such tax exemption is for a period of 15 years with an option to extend the period 10 additional years. The following facts are very important for planning purposes of structuring an Act 20 company, and the eligible services from an Act 20 company must be rendered in connection with an activity that has no nexus with Puerto Rico. It could be provided to the services to a related entity or a third party. In both cases, the exemption will be available. To maximize the benefit for Act 20, services must be rendered from Puerto Rico to avoid the tax implications of other foreign jurisdictions.
Omar, would you allow me to make a comment?
Sure.
Omar, I'm going to make a comment without we go over the next slides. For those of you that are from outside of Puerto Rico, you will hear throughout our discussion that we refer to these incentives that they are secure in a tax exemption decree. This decree is like a contract between the recipient of the incentives and the government of Puerto Rico. And even PROMESA, the U.S. tax law that imposed this fiscal board in Puerto Rico, recognize that the government of Puerto Rico has legal authority to issue these incentives by means of these tax exemption decrees. I think it is important because you will be hearing about certain terms that these decrees have, and they will grandfather any changes in law throughout the term of the decree. Thank you, Omar.
In this slide, we will be looking at the eligible services that the Act provides. We have various of the eligible services. We will not be mentioning every one of them. We would like to highlight the services that we are usually working with our clients, which are the consulting services, the centralized management services, shared services, and the call centers. On these other slides, these are additional eligible services from the Act. and I would like to highlight the international trading companies and the distribution of products manufactured in Puerto Rico. We have the first polling question, and the question is, do you have a degree under Act 20 with a fixed employment requirement currently? Well, the majority of you, okay, let's give some 10 more seconds. The majority of the answers are no, with 27 questions answer no, and 9 with yes. We'll be highlighting the recent amendments with respect to Act 20, which have been focused. The first one is the employee requirement, and specifically going historically, we have seen that there has been some inconsistencies with the public policy with respect to the employment requirement for Act 20. At the beginning, Act 20, the tax grants were issued with an employment requirement of 3 employees. Subsequently, the law was amended on 2015 to increase the employment requirement to 5 employees. And currently, the employment requirement was eliminated in 2017.
If you allow me, Omar, I want to make a comment on this. Because we have a lot of questions regarding this employee requirement. After the amendment of 2017, the tax exemption decrease under Act 20 has been released without a fixed employee requirement. However, this doesn't mean that you can have an Act 20 entity without employees. When you are exporting services, you are entering into the international tax arena. And we have to make sure that the entities that you create here in Puerto Rico have substance in terms that you have the adequate functions here in Puerto Rico to support the exportation of services. Another question that we hear a lot is if you have an employee requirement in your tax exemption decree, are you bound to that requirement? Well, yes, but you have an option in case that you can reduce that employee requirement if that employee requirement would not result in the loss of employment here in Puerto Rico. Because when this amendment was approved last year, it says specifically to the decrees that were in force that they can request an amendment to their to modify their employee requirement if that amendment would not result in an employee requirement. So let's say that you have a 5 employee requirement and you have not been able to sustain that requirement, an option could be to evaluate whether you can request an amendment. Obviously, you have to provide a good argument to have this change in your decree, but it's an alternative that you're going to elaborate. Thank you, Omar.
Sure. In addition, there was an amendment to include as part of the eligible services the medical tourism, which is a great opportunity for this industry to develop in Puerto Rico. Another amendment was the flexibilization of the body of business requirement for the international trading company. And previously, an international trading company was required to maintain or derive 80% of the gross income from the trading activity. And now that in order to comply, the company could commingle any other eligible service with the international trading company to comply with the 80% requirement. Another amendment that was enacted during 2017 was a phase-out for the base period income. in which the base period income will phase out in 4 years. And to describe what is the base period income, whenever an entity that prior to negotiating the benefits of Act 20 had export of services, they have to make an average of the last 3 years net income from the export operations specifically, and that will result on an amount that will be compared, and the benefit for Act 20 specifically will come when you exceed that amount for future years. Nevertheless, now we have that phase out that will eliminate the base period.
Yeah, I'm going to make another comment here, Omar.
Sure.
This base period is not something new in the incentives laws that we have here in Puerto Rico. Under Act 73, we have this figure of the base period income. However, the situation that we had with Act 20 was that if you were exporting prior to your application under Act 20, that net income that you were generating will have been the base period income for the 20 years of the tax grant. And any excess of that will have been the one that will have been subject to the 4% flat tax. Now, you have that base period income, but that base period income will phase out during the first 4 years of the tax grant.
And an important amendment expanding the property tax exemption to 2 additional activities is for the international trading companies and distribution of product manufacturing in Puerto Rico. Prior to such amendment, only three activities had the property tax exemption, which was the centralized management services, the church services, and the call centers. So we have 2 additional exemptions for property tax purposes.
Let's now jump to Act 22. Act 22 is the one that is for the new residents. This is an incentive for the individual. And basically, the Act 22 will provide 100% exemption on dividend income, interest income, and certain capital gains. And that's going to be structured in a decree as well that is going to last until the sunset of 2035. The main requirement from the Puerto Rico perspective is that the recipient of these incentives could not have been a bona fide resident of Puerto Rico during the 6-year period prior to the approval of Act 22, which was also in January 2012. So this individual could not have been a resident of Puerto Rico from 2006 through 2012. From the federal side, this is the interplay that we have with the rule that we mentioned at the beginning of the webcast. These benefits for dividends, interest, and capital gains will hold true to the extent that they are Puerto Rico sourced. Otherwise, since we're dealing with U.S. citizens, they will continue to be subject to U.S. taxation. So we have to see the sourcing of those type of income, and also we have to meet the criteria of being a bona fide resident of Puerto Rico under the U.S. tax law as well. And going through that criteria, from the federal tax perspective, we have 3 tests that we have to comply with in order to be considered a bona fide resident of Puerto Rico. Those are the present test, the tax home test, and the closer connection test. We're going to discuss them very briefly. They are included here in the presentation. And remember that you can access this presentation after tomorrow noon in our YouTube channel by connecting to KeyBank Grand Thornton. So briefly, the present test, you have 5 alternatives to meet this present test. The first 4 alternatives are specifically whether you have the days or not. For example, the most common that we have heard is about being in Puerto Rico more than 183 days. Also, you can average 549 days in a 3-year period, but in every year you have to be at least 60 days. Another way to meet the test if you are not in the U.S. more than 90 days. and also if you don't have more than $3,000 of earned income in the U.S. Those are the first 4 alternatives, and you don't have to meet the 4 of them. You just have to meet one of them. But let's say that you don't meet any of them. Still, you have another alternative to meet the present test, and if you can demonstrate that you don't have a significant connection to the U.S., and you can demonstrate that if you don't have a permanent home in the U.S., and let us clarify that this concept of permanent home is very broad. For example, if you have a room separated for you in your mother's house in the U.S., that will be considered a permanent home. So it's not your physical residency, but the definition is very broad. Also, you cannot be registered to vote in the U.S., and this is going to be also another factor for the other test that we're going to discuss. And your tax and your spouse and child should not have their principal place of abode in the U.S. So they have to move also. This will also hold true for another test. In 2016, we had an amendment to the regulations under the present test that now you have up to 30 days that you can be outside of Puerto Rico and outside of the U.S., and those days will count for purposes of this test as Puerto Rico days. So if you go to Europe for vacations or something that is not in the U.S. or in Puerto Rico, you can use those dates to meet the present test. The second test is the tax home test, and you demonstrate that you meet this test if you have your principal place of business in Puerto Rico. But let's say that you have multiple places of business, or for example, that you are retired, then you will meet the tax home test if you demonstrate that you have your place of abode, your home, here in Puerto Rico. And the third test is the closer connection test, and here you have to demonstrate that you have a closer connection stronger with Puerto Rico than with the U.S. And the publications and the regulation lists several factors that help you demonstrate this. And keep in mind that in case of a challenge, the taxpayer is the one that have the burden of proof. So this is the more factors that you have, the better your case. And these factors may be like, for example, location of your permanent home, where is your family, where are your personal belongings, where do you conduct your routine banking activities. For example, if you move to Puerto Rico, you should use Puerto Rico banks to pay your utilities and mortgages, etc. And also, what's the jurisdiction that you show that is your place of residency, and also the jurisdiction where do you hold a driver's license. This doesn't mean that you should not have a driver's license in the U.S., but make sure that you have a driver's license here in Puerto Rico. In terms of amendments, last year we also have an amendment that removed the requirement to purchase a residential property in Puerto Rico and established a new requirement for the recipients for the grantees under Act 22, which is that they now have to make a $5,000 annual contribution to a local charity here in Puerto Rico. This local charity needs to be certified as such by the Puerto Rico Treasury Department and needs to have operations here in Puerto Rico. So those are specific requirements in order to maintain in good standing and in compliance your tax exemption decree under Act 22.
Act 73 of 2018, the manufacturing tax exemption. Puerto Rico has had for over 70 years manufacturing incentives that have several manufacturing incentives that had transformed the economy of Puerto Rico from an agricultural to an industrial economy. The manufacturing sector has been and currently is a vital to the economy of Puerto Rico. The latest act that was enacted was Act 73 and is known as the Puerto Rico Economic Incentive Development Act. Similar to Act 20, the incentives are issued on a tax grant, which, as Francisco explained, it is a contract between the government and the entity that is negotiating the grant, and the benefits are secured for a 15-year period. In these slides, we will be mentioning different illegal activities. We will be highlighting some of them, but you will have them for your reference, and they will be available on our YouTube channel. Basically, the key supplier is one of the illegal activities that we want to mention it, in addition to the value-added activities related to the operation of Port of America, former Roosevelt Road base, considering all the investments that are coming to Puerto Rico after Hurricane Maria. Also in this slide, we have additional illegal activities, the research and development, which is one commonly used. Also the construction of affordable interest housing, among others. We will have the second post question, and the question is, how did you learn about the webcast? We'll provide 5 more seconds. Thank you for your answers. In this slide, we have the rates and exemption for Act 73. For income tax purposes, Act 73 provides a 4% flat income tax rate on industrial development income. That rate could be reduced to 1% if in case of novel pioneer industries. The income tax withholding on royalty is reduced to a 12% instead of the 29% for regular entities operating. We have 100 tax exemption on distributions, a 4% tax on sale or exchange of stocks. We have a 90 through 100% exemption on property taxes, 60 to 75% on exemption on municipal taxes, and 100% exemption on sales and use tax. These act also provide certain credits. The first credit that we have in this slide is the purchases of manufacturing products in Puerto Rico that could generate between 25 and 35% of a credit on purchases. The job creation credit, which rounds between $8,000 and up to $5,000. The research and development credit, which is usually 50% of the investment in the research and development activity. And we have various energy-related credits, which generally provides one is for the investment of machinery and equipment for renewal of energy, and the one that is known as the energy credit specifically to reduce the cost. Recent amendments to Act 73, mainly they are focused on research and development. One of the amendments define the research and development as any activity for the advancement of knowledge or capacity in science and technology. This amendment was focused in providing incentives to small and medium-sized companies as well as startups. We have also that illegal investment for R&D will include cash investments from federal grants. And this is important to mention because we will be receiving federal grants for the restoration of Puerto Rico, and maybe there are opportunities for companies that have the benefit or companies that may enjoy a benefit while obtaining such grants. In addition, we have a provision now on the law that the fixed income tax rate of 4% could be increased at the request of the exempt business. And behind this amendment, behind the reason of this amendment was because some foreign jurisdictions consider certain jurisdictions tax havens because of the rate, the income tax rate that they provide, and to avoid having, for example, consider Puerto Rico as a tax haven, this could address an issue with that respect.
Let's go to the tourism now. Act 74 of 2010 is the incentive act that we have to cover the tourism industry. And basically, we have a broad definition of the tourist activities that we can encompass within these incentives that goes from hotels, and you see there casinos. And casinos is highlighted there because casinos historically has been excluded from the definition of the tourist activity, but an amendment in 2016 eliminated this exclusion. So technically, the casinos could be covered by the incentives under this act. But the incentives go beyond the hotels and casinos to condo hotels, to tourist marinas, theme parks, golf course, and the list goes on. Even bed and breakfast now can enjoy the incentives under the Tourism Act. Instead of having a 4% flat tax as we have in Act 20 and in Act 73, in the case of tourism, we have an exemption. So we are subject to the regular tax rates that we have in Puerto Rico, but you have a 90% exemption for income tax purposes. And this applies to the income that the tourist activity generates, and also for the dividends and the gain in sale of exchange or of stocks. You have 90% exemption on personal and real property, and up to 90% exemption also in the municipal license taxes. Also, you are 100% exempt in the municipal construction excise tax and the sales and use tax. We don't have a bad system in Puerto Rico. We have a sales and use tax. Let's talk about the credits. And before going to the credits of tourism, I want to make a comment here because this has been a hot topic within the past 18 months in Puerto Rico. First, we had this committee that was created by the government that put a hold to all the credits that we had on inventory and imposed certain measurements to administrate those credits that were available back then. After the hurricanes, this committee transferred back again the administration of the credits to the corresponding agencies. So now, for example, credits that are related to tourism are addressed by the Puerto Rico Tourism Company and by the Treasury, and they don't have to go through this committee again. In addition, we mentioned about a proposed incentives code that was proposing to change this tax credit for tax grants, for cash grants. As of now, we don't have a revised tax incentives code proposal. Still, we have this under our law, and I think it's important to address what are the opportunities that we have right now for tax credits. And basically, since the enactment of this act in 2010, we had what is called the traditional tax credit, which is based on 50% of the cash that you put in a tourist project. This had a cap of 10% of the total cost, so that was the limit that this credit had since the enactment of this act. However, in 2016, we had an amendment to Act 74 to provide two alternate tax credits. And for the purpose of these two alternate tax credits, the consideration to grant the credit is not subject to the cash that you put in, because the entire financing that you get to to develop a tourism project can qualify for purposes of the eligible investment. The first alternate tax credit is under Section 5B1, and it's up to 40% of the eligible investment. However, this credit will be released in 3 equal installments commencing on the second year of operations of the exempt business. On the other hand, you have under Section 5B2 a credit that is up to 30% of the eligible investment, and this will be released sooner. For example, you'll have 10% of this credit as soon as you secure financing, and the remaining 90% will be released in a 3-year installment, commencing when in the year that the exempt business receives the first paying guest. And also, for purposes of this alternate credit, the project cost definition is expanded, and if you have at least 70% of the total development that you are conducting that is actual tourist project area, the 100% of the development will qualify for purposes of the cost that you can secure the credit. This 30% requirement only applies to these 2 alternate credits. And here we have another poll question. Actually, it's not a poll question, but we want to know if you want to be included in our mailing list. So if that's the case, please use this box to write down your information, and we'll add you to our mailing list. You can withdraw from that list just by notifying in case in the future you want to do so. So we're going to have some few moments to give you time. Looks like we're going to have some new members, so we thank you for that. So let's talk about the federal tax rules and the international provisions of the U.S. tax reform. Before going to the changes, we're gonna discuss 100 years of federal tax milestones for Puerto Rico in just 1 minute. But we want to give you the background of how we end up where we are. Since 1921, we had one of the first exemptions that we had in the U.S. tax law that provides for U.S. corporations an exemption if they conducted at least 80% of their gross income in a U.S. possession, and at least 50% of their gross income was from an active conduct in a U.S. possession. So back then, if the U.S. corporation had those ratios, 80% of gross income and 50% of active business, and they were in a possession, the income that they generated in that possession was exempt. So it was the same U.S. entity conducting business in the U.S. possession, and it was exempt if they meet this criteria. In 1954, Section 931 came into play and expanded that if the U.S. corporation was meeting those ratios that we discussed, all of the income, not only the one from the U.S. possession, but all of the income that was not from the sources of the U.S. was exempt. In 1976, we have a change, and that was when Section 936 came into play, and basically it changed the exemption for a credit, but maintain also the 80% and 50% requirements. That's when QIPSI and other requirements under Section 936 came into play. And we had Section 936 for 20 years. There were several changes during that period of time. But in year 1996, the phase-out of Section 936 came with the 1996 Act, and it was repealed. And there was a 10-year grandfather that allowed for a transition, and that's when most of these entities converted to the term controlled foreign corporation, which we commonly refer to as CFCs. Prior to this date in 1996, we were dealing with U.S. entities that were conducting businesses in the U.S. possession. After that, now we have foreign entities that are conducting businesses in the U.S. possession, and the planning was transitioning from an exemption or a credit to a deferred status for the CFC. So let's define what is a CFC. Basically, a CFC is a foreign corporation for purposes of the U.S. in which more than 50% of its voting power or value is owned by U.S. shareholders. Obviously, we have to define what is a U.S. shareholder. And a U.S. shareholder is a U.S. person who owns directly or indirectly, and there are some attribution rules that we have to consider when we are making this test, that owns at least 10% or more of this of the voting power of all classes of the shares entitled to vote. And the U.S. person, this is defined as any U.S. citizen or resident of the U.S., U.S. corporations or partnerships, any state is also considered a U.S. person. And what happens to the bona fide residents of Puerto Rico then? Well, there's an important exemption for the Puerto Rico bona fide residents, and it's that for purposes of the entities that are created here in Puerto Rico, the bona fide resident of Puerto Rico is excluded from the definition of a U.S. person. So if we have an ownership in Puerto Rico, an ownership of an entity in Puerto Rico that have more than 50% of its ownership by bona fide residents of Puerto Rico, we don't have a CFC, and most of the issues that we're going to be discussing will not be applicable. And what changed for the CFCs with the U.S. tax reform? Before the U.S. tax reform, as I mentioned before, the strategy was deferral of the current U.S. taxation of income. Basically, the earnings of a foreign corporation were not taxed by the U.S. until such foreign corporation issues a dividend to the U.S. Back then, we have to, and still, we have to keep in mind that there's a provision on the Subpart F of the U.S. Code that entity has to provide substance and needs to work as a standalone entity, and the U.S. shareholder cannot manipulate that CFC because otherwise it would trigger like a flow-through for them. But now the new and additional changes that we have basically are three. We see that the U.S. moved to a quasi-territorial system by introducing the figure of the dividend received deduction for the U.S. corporations. In order to transition to this quasi-territorial system, we had to phase out a one-time tax on the previous unreported earnings and profits as a transition. And we have two significant anti-base erosion provisions, GILTI and BIT, which we are going to discuss in the next slides.
Okay, for prospective distributions after December 31, 2017, the U.S. owners will enjoy a 100% dividend received deduction. Nonetheless, all those earnings and profits before December 31 that were not distributed, they will be subject to the one-time tax. Basically, what the one-time tax does, you're going to be summarizing the earnings and profits of the CFCs, and will divide the earnings and profits between the cash and cash equivalents, which will be subject to a 15.5%, and the non-cash, which is subject to an 8%. There is an election that the one-time tax could be paid in 8 installments over a period of 8 years, and for corporations, there are available foreign tax credits and the nets of EMPs on deficits. The Global Intangible Low Tax Income, known by the acronym of GILTI, GILTI provisions are designed to impose minimal residual U.S. tax on above routine earnings of a CFC. And what is what is determined an above earnings for purpose of GILTI is in a simplified form is a gross income of the CFC less 10% of tangible property, which is property subject to depreciation less certain interest expense. Such result will be GILTI inclusion income, which will be included in the income of the U.S. shareholder in the same way as Subpart F, which eliminates the deferral, and it will be taxed similar to a flow-through every year as part of the gross income of the owner. It is important to mention that there is the U.S. domestic corporations have available a 50% deduction from GILTI, and they have available a foreign tax credit against what they pay in the foreign jurisdiction, but it is limited to 80%. We have a polling question. The question is, do you have a U.S. individual as part of your ownership structure in Puerto Rico with a Puerto Rico entity with incentives? Thank you for your answers. Prior to the tax reform, the structures that were used for an Act 20 company to be conducting business in Puerto Rico is this one that is illustrated in this slide, in which the Act 20 company had, for example, two partners in which the Puerto Rico bona fide resident had 10% and the U.S. partner had 90%. At the end of the year, the company paid the 4 flat income tax rate on the net income from the active service income, and upon distribution, the Puerto Rico individual partner will be totally exempt from taxes in Puerto Rico, and the U.S. partner will not be subject to Puerto Rico taxes also, but will have to pay the tax on the distribution at qualified dividend rate, which is the 20% plus the 3.8% of Obamacare.
Let me summarize what you mentioned. Prior to the U.S. tax reform, the typical structure that we had on the Act 20, for example, if we were dealing with a CFC, is that for purposes of the U.S. residents that were individuals with ownership in the Act 20 entity, it was a deferred strategy. You wanted to have the Puerto Rico entity generating net income at the 4% tax and defer all the U.S. taxation up to the moment of the distribution. At such moment, when the earnings and profits from the Puerto Rico entity were distributed to the U.S., the U.S. individual will have been subject to a qualified dividend on that transaction?
Okay. On the next scenario, we will be illustrating that same structure after the tax reform and how it will affect the U.S. individual owning that control foreign corporation. At the end of the year, that entity will be subject to the same 4% on the net income, and the distribution of the Puerto Rico partner will also be totally exempt. Nevertheless, the GILTI will come into play every year for the part of the net income, and it will be subject to be taxed in the U.S. as part of the gross income of the U.S. shareholder at normal ordinary rates, specifically similar to the Subpart F. Strategies to lower the GILTI impact, avoid being a control foreign status, and how we can accomplish avoiding the CFC status. Maybe the U.S. owner moving to Puerto Rico and owning more than 50% to avoid the CFC status specifically. Instead of the individual being the owner of the Act 20 company, a U.S. holding company, a domestic corporation, be the one that is the owner directly in between the Act 20 company and the individual, so they can take advantage of the GILTI deduction and the foreign tax credit that we already discussed. There is individuals has an election at the individual level specifically through Section 962, in which they can elect to be taxed as a corporation in certain transactions. There are uncertainty with these options because of some issues with double taxations. So proper discussion with the tax consultant should be done before making such election. The base erosion anti-abuse tax, known by the acronym of BEAT. The BEAT is impose a minimum tax on income on large U.S. companies, usually multinationals, making certain that are charged from foreign-related entities significant amounts, and usually this will address specifically charges from foreign-related entities to U.S. companies with an average of gross receipts of $5,100 million in the last 3 years. Specifically, this could affect Act 20 companies which have the pharmaceutical industry. However, the BEAT will not be applicable for inventory costs, which are included on the cost of goods sold. So the immediate impact on the pharmaceutical will be reduced with respect to the BEAT tax.
Unfortunately, we're running out of time. We're close to the hour that we compromised at the beginning. We have received several questions, and we have the person that initiated those questions, and we are going to be sending an email to each of you addressing our comments on your concerns or questions. There may be additional questions that you may have, and you have in our presentation or our contact information, so please contact us if you want to discuss something in particular. As part of the poll question, we have several U.S. residents that have ownership in the Act 20 in the Puerto Rico entities with incentives. Keep in mind that changes to your structure are still available until December 31st, 2018, in order to avoid the implications of GILTI. And there are strategies that we can use to mitigate those implications. So thank you all for joining, and we'll keep you alert on any additional